When are your exams?
Ma'am, ACCA exams are
5th March.
Your BCom exams.
ma'am, BCom exams are between 2nd and 4th March.
Okay. So 5th March is?
Ma'am, it is for ACCA.
Yeah, yeah. So you're writing?
Ma'am, I will be writing in June.
Okay, good. Because sufficient preparation should be there, without which we should not attempt for the exam. So
Yes, ma'am.
I think you will thoroughly prepare by then and then write that. Anyone writing in March?
Yes, ma'am. I think might be others be giving in March.
Okay, okay. Prepare well. Okay, concentrate and prepare well. You still have one more month in between. So I think you should be able to do it well.
Yes, ma'am. Ma'am, could you please share the recordings of Monday? Actually, I was not able to join. I was traveling at that time.
Okay, I didn't send it. Okay, I'm really sorry. I'll send today's class and then Monday's class, both of them together after the class
Okay,
ends.
ma'am.
Yeah.
Ma'am, and Friday's class also.
Mondays and today's two classes together.
Okay, ma'am. Okay, ma'am.
Okay. Um, then topic what we are starting today here is what is macroeconomic policy. Are you aware of what is it macroeconomic policy? A policy for the economy. Okay. Um, what do you understand? Do you know about it? Okay. So
Ma'am,
it's, yeah.
the policies which are framed for the whole world. It is
No,
not for
only
the
for the economy, economic, no economy. It's not for the entire world. It is not global. It is economical. So only specific to one economy. Yeah. Yes. Yes. Continue, Simran. Okay, so there is an economic policy at a macro level. It is not at a micro level, at a macro level. So overall, so we are focusing on overall a policy which focuses at a level of economy, looking into the economy. So what do we understand about what can be managed or at the macro level, considering the entire economy, is what we have to understand. What do you think? Now, whose responsibility is this to manage the affairs at the economic level or at the nationwide level? So it is definitely the responsibility of the government. So government looks into these things. So what are the things which the government has to focus on, look into, and have an object or a goal to achieve for the economy? So generally, we see that. In the economy overall there should be development. So we talk about development, growth and development we talk about. Then there are certain resources in terms of funds are available, resources in like the natural resources are there, those have to be put to use. Then people are there, okay, manpower is there. So we see that there are various resources which are available in an economy. So all these resources have to be put to use. See, if there is productivity which we are looking at, if we are talking about the activity to go on smoothly at a level, the productivity should go on at a maximum level, then we have to first pump in certain resources. So the resources which are there in the economy, all the resources, first identify what are the resources the economy has and put these resources to use. Okay. um, Now see, India is rich in so many resources. We see that, okay, we have agricultural product which is there. I mean, the agricultural product to have that, we have I mean, large, I mean, amount of cultivatable land. Land is there. That is main resource. So, in certain countries, we see that land is there, but yet they cannot cultivate that. Then we see that India is covered by coastal line on three sides. Then we have like that. If we keep on mentioning that, we have so many resources which we can put to use. So utilizing these resources, how can they improve their productivity? How can they put these things into best use? Okay, now if we see that the Middle East countries have their resources are oil wells are there. Okay, some countries are rich in okay, forest area or things like that. We see that each economy is has a certain amount of resources. They, unless and until they put to use, okay, if we claim that we have land, if that is not put to use, if that is not used at all, then it is of absolutely no purpose. But when the land is used or put to use, then we can see that there is some output which is generated. So the first thing is the government looks at how to use these resources. And in an economy, we see that there are cycles, trade cycles going on. Then we see that sometimes the prices rise, sometimes the prices fall. See, when the prices fall, it is a loss for the producer. When the prices rise very high, it is a loss for the consumer. So all the time there should be a balance between what is the right price which should be charged for the products and services. So to look into that now, otherwise see, there are so many others involved in this whole this entire cycle of activities which go on. So in this situation, if there is no intervention of government, middlemen play a major role. Then the producer, because they're producing, they may end up charging a very high price, or create certain kind of scarcity and then raise the prices or things like that. In such a case, it is also to ensure that the prices are stable. There is no variation, too much of a variation that only one party gets benefited. So another important role is about the price stability. Then we see that when the resources are put to use, then the economy grows. So it is also to ensure that there is growth which happens in the economy. Economic growth, economic development is what is the important point the government also has to focus on. Apart from that, then um, we see that it is not only within the economy, only that in the country only things happen, but there are trade links with other countries also. There are exports taking place, imports, downloading certain things, or um, I mean purchasing things from other countries and importing those things. So in this case we see that there is foreign currency involved in that. So how they are making the payments for the imports, how they are receiving the foreign currency in case of exports, and then have a balance between these transactions, so that their balance of payment would be there, because everything has to be treated in foreign currency. So there is an involvement of foreign currency, foreign exchange. Then here we have to understand that while using the foreign currencies, they should not have too much of imports that they are all the time paying, and then very little of exports. So to see that there is a balance, what they are paying and what they are receiving should balance there. So there is a balance of payment equilibrium. That's another uh, uh, goal or objective or focus area for the government. Then whatever is the wealth income which is earned in an economy, that has to be um, in a way it is equally distributed, or distributed in a way that it is not that we see that the rich become richer or the poor become poorer. So such things should not happen, but to look into that the income and wealth of an economy is distributed equally or appropriately. Okay, so that part of it, it is not that the income is concentrated on only in one group of people. Such things do not happen. The government has to focus. So here it is not individually, each one of them are independent of each other. So when they are looking at growth, then maybe the then we are also talking about equal appropriate distribution of wealth. So growth, it is not only should be concentrated in one group, one sector, one. So there should be even growth, there should be equilibrium, there should be a balance between what they are talking about, the growth part of it. Okay, when growth happens, then then we also see that um, how is the growth happening? Is the growth happening because of mm, too much of imports and too much of exports, or um, like this? We have to understand that. Then balancing all these objectives, that is, all the resources have to be used. Then they have to focus on the growth of the economy. They have to look at the price stability. They have to look at the balance of payment. They also have to focus that the income and wealth is not concentrated on only in one area. So these things are under the purview of decisions for the government of any country. So it talks about the monetary policy, but it also now the here in the PPT we see that macroeconomic policy is to maintain stable aggregate demand that helps business plans in investment, employment, output. Okay, and it also influences the cost. What are the various methods of influencing the cost? That is what we have to look into. Fine. So first it says that it has to maintain aggregate demand. So aggregate demand for what? Aggregate demand for the goods and services which are produced in an economy. So the first point of it, it says that it has, the government has to maintain, or the macroeconomic policy which is framed by the government. So macroeconomic policy has to maintain stable aggregate demand. Okay, if what is aggregate demand? The total demand. Aggregate is in total, that is what is the meaning of aggregate. So the aggregate demand, or the total demand for the goods and services which are produced in the economy. So the what happens if the demand falls? Then it is a loss for those who are producing. The goods and services would not be sold. If the demand rises too much, then in that case also there is a problem, because when the demand rises and the scarcity and the supply is limited, in that case prices rise. So either ways it is not I mean good. Therefore it has to ensure that the aggregate demand is maintained at stable level of aggregate demand has to be maintained. Then the demand for the it by maintaining the stable aggregate demand, the it also says that it helps in business plans in terms of what is the investment required. So suddenly the demand rises, then to meet the demand, then they have to arrange for the additional infrastructure, facilities have to be arranged. So investment has to be looked into. Otherwise, now if they, I mean, if they understand what is that predictable future, what would be the demand in the future, if it is understood, then they can take care of the investment part of it, how to take care of the employment, people to employ the manpower, the resources, and what is the output. All these things can be planned. If there is uncertain demand, so the producers would not know whether they have to produce high volume of output or low volume of output. So it is very important that the aggregate demand of the goods and services is maintained stable. Okay, not too much of variation. So yes, it is not that it is constant, but maybe if there is a growth in demand, maybe a 5%, 10%, or whatever it is, there should be a set pattern, or it should be predictable. It is not that it is unpredictable. So ensuring that what would happen in the future, and to meet the requirements of the future, the planning has to be taken up. So macroeconomic policy focuses on maintaining stable aggregate demand. When the demand is the total demand for all the goods and services is maintained at a stable level, then we understand that the business producers um, will be helped in a way that they can take up the planning for the investment the output, the employment of resources and the output which has to be generated. Then macroeconomic policy also influences costs. It also influences costs. What are the various costs which are incurred in an economy? So first thing we see that the overall students have joined. Okay, what are the various business costs which are incurred is what we have to first understand. What do you think are the costs which are incurred? The costs which are incurred for a business are in terms of, there is a mention about that. We have exchange rates mentioned, fiscal policy, taxation is mentioned, monetary policy, interest rates are mentioned. So the macroeconomic policy also has to look into the cost part of it, the business costs which are incurred. So the policy also has to influence costs. And what are the costs? Various costs which are focused on, what are the ways in which, or what are the methods in which there is an influence on the business cost is through exchange rates, through fiscal policy, taxation. Then there is a monetary policy. We will understand what these mean. Monetary policy, interest rates. So these are the things what are mentioned. So coming to the exchange rate. So if we are talking about exchange rates, what are exchange rates? What are exchange rates? See, when one country transacts with another country, since these countries have different currencies, the rate at which they are exchanged with the other countries' currencies is the exchange rate. Okay, so if India's currency is Indian rupees, some other country's currency, if it is Japan, Japan has a currency called yen. So India is trading with Japan. So what is the rate? See, $1, 1 Indian rupee is not 1 yen. Okay, it is different. So at what rate would this currency be exchanged with the foreign currency? Okay, so that is the exchange rate. So it has an influence on what is the exchange rate. The exchange rate, see, when do they have to use this exchange rate? See, when they import goods, at that time, payment, let's say, suppose if India is importing certain goods from Japan, in that case, India cannot make the payment in Indian rupees, but it has to make the payment in yen. So if it has to make the payment in Japan's currency, so how many yens have to be paid for these imported goods? Okay, if there is a fluctuation, so let's say that at the beginning of January, let's say January 1, they have entered into an agreement to import certain goods. Now, as on that date, there is some value of yen. Then coming that at the end of January, it would be delivered. Let's say the 30th January, it would be delivered. So as on the date of January 1, they entered into an agreement, some price of yen would be there. So it is understood that it would be settled at that particular rate. But then as on January 30, when the goods are delivered, at the time of delivery of goods, if they are to make the payment, and if there is a lot of fluctuation in the foreign currency, that will impact their decision to import goods from Japan. Okay, so now the policy also has to impact the exchange rates. It cannot just I mean, if it is not taken care of it, there would be a rise or a fall in the foreign currency that will get affected. Okay. um, so if the exchange rates increase, then their cost of material is increasing. Why? Because they are importing their material from Japan or some any other country for that matter. So the cost of material what they are importing from the other country increases. When the cost of material increases, the overall cost of production, cost of goods, sold, everything increases. So if there is no effect on the policy to control the cost, the business cost will increase. The business cost, one of them is in terms of exchange rates. The second one, what we look into is the fiscal policy taxation. Okay. Um, Now, taxation, the tax is levied on the overall profits which are um, earned, or any income which is earned by the people in the economy. So, now if the tax rates rise, then it is additional cost for the people in the economy. Okay. Um, it is not only that we see only one type of taxes there, but multiple taxes are there. We see that there is a direct tax, we see that there is indirect tax. Then, as a part of that, again under indirect tax, we have various other things. Now, of late, in India, we get to listen to so much about GST, tax on goods and services. Then we see tax on okay, any product which is sold, there is a sales tax. See, we see that there are so many types of taxes. Then there is tax on the income which is earned. Now tax paid on so many aspects of it. So the how much would be the tax rate, what would be the burden on the people in the economy, also has to be looked into by the government. Because if suddenly they rise the prices, now every now and then we see that the rise in prices of certain products, we see that, and then there is a rise in taxation. When GST was um, introduced, and then there was a big hue and cry, because I mean, people were talking about what is this, that would leave a burden on the people in the economy and all. So government had to justify what was the reason behind that. So there are so many things about it. So once there is a difference, or once there is a change in the taxation policy which is adopted by the government, that
Ma'am, we
will.
are not
Yes.
able to hear you.
Not able to hear me? Okay. Is my voice breaking? Is my voice breaking?
Ma'am, to me, your voice is clear.
Okay. Um, I'll just a minute. I'll put the headphones and then I'll speak on the mic. Just a minute. For all of you, it is not clear.
Now your voice is clear.
Okay. Once check your internet connection also. Sometimes, if the internet connection is not stable, then also this problem arises. So
Okay,
it could
ma'am.
be. It
I
could
think,
be. Okay.
okay, ma'am.
So when we see that there is a change in the taxation policy also, that the business cost gets affected. So there would be a burden on the business concerns, or there would be a burden on the people in the economy. Right? Then we see the interest rates. The monetary policy is about the interest rates. So interest rates, what are the interest rates in the economy? Interest rates. Interest is paid on what type of capital? We have learned already. Interest is paid on debt capital. Okay. So now debt capital, if there is a change in the change in the interest rates in the economy, then debt is assumed to be as it is understood to be as a cheaper form of debt capital. If there are variations in the interest rates on the, if the interest rates are going to change on the debt capital, then I mean that proportion of capital structure which is used in the total capital, that gets affected. Assuming debt is a cheaper form of capital, business concerns generally go in for raising debt capital and employ that um, in the business. But if there is a variation in the debt capital, if in variation in the interest on the debt capital, then their interest in employing debt capital and using it in the business also gets affected. So it is a part of the monetary policy. We are going to see what it is. It is a part of the monetary policy, and the variation in the interest rates also will influence the overall cost of capital for the business. So we see that macroeconomic policy, or the policy which is framed by the government for the entire economy, has to look into how they maintain an aggregate demand for their uh, for the um, goods and services produced in the economy, the total demand for all the goods and services produced in the economy. How do they maintain an aggregate demand for that, stable demand for that? So once the demand is stable, they can take decisions for the investment, employment, and output. Then it also would influence the cost in terms of what would be the exchange rates, then the taxation policies adopted by the government, and the interest rates which are used or which are prevailing in the economy. So these things have an impact on the overall cost of the business, and that gets affected. So going further, next topic what we have, it is monetary policy. So monetary term is monetary. So monetary relates to anything related to money aspects of it. So monetary policy focuses on, because there is money in that money, or wherever there is money, we are also focusing on the liquidity part of it. So that is also one part of it. Okay, monetary policy, as we have mentioned, that it is related to the liquidity part, or the money involvement of money in the economy. Okay, so the overall flow of money in the economy, how does the money flow in the economy? To look into that is there is a monetary policy to ensure that the flow of money, or the liquidity aspects in the economy are looked into, taken care of it. Okay. Mm, so what happens if there is too much of flow of money in the economy? People have too much of money to buy. There, everybody has lot of money in their hands. What do you think? What is the impact of that?
Value of our own currency falls.
Value of our own currency falls. Why? Because when people have lot of purchasing power, then they are not very particular about how much should they spend. So they are willing to spend any amount. When they are willing to spend any amount, then the price rises. When the price rises, that causes inflation in the economy. Then again, then we see that the value of the money falls. So too little money that they are not even able to purchase also is not good. Okay, that also leads to certain kind of issues in the economy. There is a recession. These are problems in the economy. So the how much should be the flow of money has to be taken care by the government. So if there are situations, then they come out with their strategies as to pump into a lot of money into the economy, or um, take the money from the economy. So when they are pumping in a lot of money into the economy, they come out with various offers. So they encourage banks to give loans to the people, or they are very rigid on issuing loan amount, or cutting down on that, or recovering everything from the economy. So from time to time, they also have their own strategies as to how much should be the flow of money into the economy. And um, things are also managed with the changes in the rates, interest rate. Suddenly we see that the bank rate, interest rate rises or it falls, or there is some percentage change. Now, because in this crisis moment, the government wants to encourage many micro units to start their business, or many entrepreneurs are invited to come forward to establish that. So government is also coming out with the various schemes and then offers, and then the interest rates have fallen in the last 1 year. We have seen that the government has come out with policies about reducing the interest rate on many aspects. So then what happens, people get involved into various activities. So there is some kind of activity, productivity going on in the economy. So controlling the flow of money relates to monetary policy. Okay, so the monetary policy effects, what are the monetary policy effects which are there? The availability of finance, how much should be the finance or the money which should be available in the economy. So availability of finance. So they come out with their own strategy about issuing more loans to the public, or people have, then they have money in their hands so that they can take decisions, or um, discouraging them from going for loans. That is, by rising interest rates, they would be discouraged not to take loans from the banks or other institutions. Okay, then it impacts on the inflation. Because of too much of flow of money, there would be inflation. Then the cost of finance, what would be the interest rates of these finances? That is another thing which is decided by the government. So also having a control on what would be the exchange rates. Okay, what should be the levels of consumer demand? So we've already discussed that under the macroeconomic policy about maintaining stable aggregate demand. So levels of consumer demand also, it looks into that. Okay, so that would be about the monetary policy. Then we see what is about the fiscal policy. So what is fiscal policy? So when we talk about what is fiscal policy, what is fiscal policy?
Ma'am, in which we look into the public expenditure and
That's
public
right.
revenue.
That's right. Yeah, public expenditure. So how are the finances spent? How are the funds which are available spent by the government? So on various schemes, the government spends. So some of them are service related, wherein there is not much revenue which is received as against that. So it is spending on that. Now welfare activities, health care, education. Some of till a particular level in the government schools and all, we see that it's absolutely no fees or very less fees, or encouraging people to take up higher education. Then hospitalization, these things, we see that government spends these amounts on various welfare activities. Then how would they, how, what are the sources of income for the government? So the major source of income for the government would be by collecting taxes from people on the incomes which they have earned, on the purchases of the goods and services. The people in the economy, they pay the taxes in various forms. So taxation, that is taxes which are collected from the people in the economy, is a major source of income. Then that may not be sufficient all the time, so government also has to borrow from various sources. So once the amounts are borrowed, the amounts are collected from people, what is that which is done out of that? So they are invested into a particular cause. Sometimes it is for some return as against that investment. So they would earn certain things. I mean, there is productivity, there is an activity, so then they earn some amounts and then they can repay the borrowings. Screen not seen, sorry. Okay. As against the as against the amounts which are spent by the government, um, they should also put these things into some productive activities. When they earn returns from these productive activities, they can always repay the funds. Okay, then they also have the tax amounts which are collected, that also can be put into use. So government has to take a decision to balance between what are the ways in which it would be spending. Now certain things which are invested, like if we are talking about the welfare activities, the healthcare, the education, certain things which we are talking about it, see, these are investment made by the government. As against that, we do not see any return coming out. But yet if the people are educated, yes, the economy also gets benefited. If the people are healthy in an economy, they get, the overall the country gets benefited, the economy gets benefited. So it's kind of a social investment. Maybe the returns are not realized in the form of profits, but yet the economy gets benefited. So now government has to decide, see, what is the requirement for various activities, various things on which it has to spend, and what are the sources from which it would be collecting these amounts. One is taxation, one is borrowing. So what is the requirement, what is the availability, so how are they spending on that? So that, those are the decisions which have to be looked into. So what are the possible effects of fiscal policy? What are the possible effects? First one is the economy will be boosted. Boost economy by way of spending amount, uh, investing into various activities, whether it is social investment or investment which can give some benefit immediately or something like that. So we see that there is spending, and then that has an impact on the economy. The economy will be would be boosted. After that, we see that there are disincentives. So what does it mean by disincentives? Sorry. To encourage uh, a particular activity, it comes out with granting certain subsidies or grants to certain businesses, and at the same time it also to discourage some of them. um, then it can also talk about um, not granting any of them, or disincentives, that is, it is not extending anything in the form of incentives or anything. um, Certain businesses, mm, which are not good for the economy, or certain businesses like here we see the positive influence on habits, like we see there is a indirect taxation on cigarettes. Certain businesses like suppose bars and all are there in a particular city, so the government also says that these are there, but they can be run only until a specific time period. So it is not all through the night that the bar can be open. Maybe some 11 o'clock or something like that. Certain restrictions are levied on some businesses which are not good for the country or for the people in the economy. So some kind of a restriction which is put on certain businesses is disincentives, disincentives are sorry. Then positive influence on habits. So it also talks about for example, high indirect taxation on cigarettes or all tobacco related products or liquor related products. We see that. Okay. Then we see that crowding out, where government demand crowds out, where government demand crowds out private demand. So crowding out talks about government enters into that particular sector, or it discourages um, no, this is encouraging. So government encourages certain things, and then it comes forward to invest the amount into that particular sector, so that private players they are discouraged. So crowding out. The point here is crowding out. Crowding out, discouraging people who are investing into particular thing, because government comes forward. When government extends loans, or it comes forward with finances, these are relatively cheaper. So the investors also look forward to borrowing from government. So banks are encouraged to give loans and all. So then what do people see? They do not go to these private parties, but they come towards, I mean, get attracted to the lending, the of funds. So they get attracted to borrowing the amounts from the government. So where government demand crowds out private demand. Okay, so that is crowding out. So these are the issues related to fiscal policy. Why do we have to learn that? So this is important, that now when we are discussing about the cases, so any particular policy of the government, so inbuilt into that, so technically we do not have to learn in detail about these policies, but yes, in the cases which we are going to solve in the examination, any point related to that may have an impact on their income, may have an impact on the decisions which are to be taken by the entrepreneur, the business, the management team has to focus on that. So there is a change in the government's decisions about these policies. So what is the impact on that? So we need to have an idea about what these policies are. So brief understanding about that is very important for us to know what are these policies and what impact it would have on the business, any business. So specifically when we are discussing the cases, at that time it becomes useful for us. The next topic is about financial markets. What do you think is a financial market?
Ma'am,
Market, yeah, yeah.
financial markets are the market in which the financial instruments are being traded.
Very good. The financial instruments are created. It may be a physical place, it may not be a physical place. So market is generally a place where goods are bought and sold. But financial market, not necessary that there is a physical place. So for some of the financial instruments, there is no physical place, but yes, some of the financial instruments we see that there is a physical place, like a stock market is present. Okay, so a place where a financial market is a market where the financial instruments are traded. Okay. Um, Now, what do these financial markets do? The financial markets deal in long-term funds. Long-term funds which are traded in the capital markets, and it also deals in short-term funds which are traded in the money markets. So how do we differentiate between the capital markets and the money markets? So money markets, the instruments are for a period of 1 year, 1 year or less than 1 year, the time period. So the division, the distinction between these two types of markets is based on the time factor. If the financial instruments are traded and it has a life of a period of 1 year or less than 1 year, we call them as money market instruments. But if the time period is greater than 1 year, we call them as capital market instruments. Okay, so the instruments which are traded in the capital markets. Okay, so the financial markets deal in long-term funds, that's the capital markets, and also the short-term funds in the money markets. Then we see that the financial markets provide intermediation. What does it mean by intermediation? Playing the role of an intermediary. Okay, intermediary. So intermediary connects the two parties. So they act as a middleman. So they can connect the businesses with the investors. So they act as a intermediary between the investors and the businesses. Okay. Then it also deals with primary and secondary market. What is a primary market? Primary market is wherein there is an issue for the first time. But those instruments which are traded again, we call that as a secondary market. Secondary market where already issued instruments can be resold, and I mean it can be traded again. So that is a secondary market. The primary market would be wherein the instruments are issued for the first time. That's the primary market. Then it allows for diversification, investing into multiple investments instead of going only with one type of investment, investing into multiple types of investments. Then it diversification always results in managing the risk, shifting of risk. Manage Diversification deals with risk management. Then shifting of this risk to third parties. What does it mean by shifting of risk? Risk is to be borne by the party who's involved in investment of the amounts, but the risk is something, if it is shifted, what does it mean is uh, when there is a possibility of insurance. Insurance is one way wherein the risk is transferred to a third party as against a premium amount. So shifting of risk. Then we see hedging and entering into some derivative contracts so that they can manage their risk. So that is the concept of hedging. We're going to see that after a while. Then arbitrage. Okay, arbitrage is um, I mean, involving in an activity of buying in one place and selling it in another place. So that's called as arbitrage. So it allows for diversification, shifting of risk, hedging, and arbitration. So financial markets are markets where the financial instruments are traded. They are bought and sold. Now, it involves or it deals with the long term financial instruments, the long term funds. Like we have learned about what are the sources of capital. Under that we've learned about long term sources, long term liabilities like debt capital, notes, long term loans. All these things are long term liabilities. Then we also have looked at what is equity. Equity is the preference share capital and the ordinary share capital. So these are long term instruments. Okay, then we see the short term. We have not discussed these instruments which are there in the short term. Okay, there are many instruments which are dealt in the short term. So deals in short term funds. It also acts as an intermediary. So intermediation. So it helps in connecting these markets, help connect the investors and the businesses. Then we see it deals with the primary markets and the secondary markets. The first time issues are primary markets, and then reselling these instruments is called as secondary markets. Then it allows for diversification, shifting of risk, hedging, and arbitrage. Money markets. Who are all involved in money markets? What is the criteria for a money market? We've understood money market to be a market where short-term funds or short-term financial instruments are dealt. So who all are involved? Starting from government. So we see that the concerns which are involved is, we see the authorities, the local authorities. Okay, then we see the investment trusts, the commercial banks, the central bank, the RBI, commercial banks are there, central banks are there, finance houses are there, building societies are there, unit trusts, large companies, private individuals. All these are the parties which are involved in money markets. So now government, maybe they are not directly involved, but through the central banks also, this sometimes we see that there are certain money market instruments which are issued, so through the central bank. So we see that all these are the parties or participants who are involved in money market instruments. Capital market, the time period is mentioned as a period which is greater than 1 year. So that's the criteria. How do we distinguish? So in simple terms, so even during interviews also, when you are asked about how to distinguish between a capital market and a money market, the first point which has to be highlighted, apart from the other things, the first point which has to be highlighted is it's a market which has a time period, or which deals with the instruments which have a time period greater than 1 year. So deals in longer term finance, that is greater than 1 year. Then what are the major types of securities which are dealt under capital markets? The first one, we see that public sector and foreign stocks. So the stocks which are issued in the public sector, so those sectors wherein the government has a stake of more than 50%, we call them as public sectors. Then such things. And also we see that in case of foreign stocks, so any investment in foreign companies, and also it deals with major types of securities like public sector and foreign stocks. Then other companies, so the private sector, so company securities in the form of shares and bonds. Okay, bond is a debt capital. Maybe you are not aware of it, but um, um, generally we do not, I'm of course in Indian context, and earlier also during this FM class only, we have looked into the examples of debt capital is debentures. So that is very commonly, very frequently we use that term called as debenture. Okay, debenture is one type of bond. Technically, when we look into the differences between what is a bond and what is a debenture, debenture is one type of bond. But in a generic sense, when we talk about debt capital, we always use this term called as bond capital. Bonds are issued by the company. Okay, bonds are some of them also have this understanding that bonds are always issued by government, not necessary. Bonds are also issued by the companies. So government also issues bonds, but it's not always that it's only government who issues bonds. Um, the debt capital which is issued by the companies, we call these things as uh, bonds. The equity capital which is issued by the companies, we call them as shares. Okay, shares and bonds which are issued by the company securities, shares and bonds. Then euro bonds, one type of bonds is euro bonds. So these things Then the capital markets also they deal in major long-term finances, the major types of securities. Then we see the international capital markets, wherein domestic funds supplied to foreign users, foreign funds supplied to domestic users. So the capital markets also deal with or look into the supply of the supply of these funds to the businesses. The domestic funds are supplied to the foreign users, and the foreign funds are supplied to the domestic users. So they act as an act in between these foreign companies which are established in other countries, and they help in dealing with the securities of foreign countries. One second. Okay. uh, wait a minute. International capital markets. uh, Okay, so these capital markets also help in connecting the foreign companies with the domestic investors, or domestic companies with the foreign investors. So they are most important in euro markets, foreign bond markets. So see, if the bonds are euro bonds, if the bonds are issued um, by a domestic company, and the investors purchase or they deal in these bonds. These are domestic countries bonds, but international capital markets, since they are connecting with the foreign companies. So when the domestic investors are investing in foreign companies securities, that is foreign currency, foreign companies bonds, um, bonds which are issued, the it's a debt capital, but on issuing the debt capital, the investors subscribe, they purchase these bonds. So there is a certificate kind of thing which is issued to the um, bond holders. So we call that as a bond indenture. So kind of a certificate. So on that, there are terms and conditions would be written. What is the face value of that? What is the time period? What is the interest rate? Then there is a covenant. There is a promise written on that. So that is a certificate kind of thing which is given to the investors. So on the certificate, if at all, if the currency which is denoted, because these are, I mean, there are certain promises made in case of bonds, that is periodically they are entitled to receiving an interest amount, and at the end of the term period they are also entitled to receive the amount of bond capital, whatever is promised. So they are entitled to receive these things. But then, since it is a foreign company's bonds, now these foreign companies' bonds are not going to pay the domestic currency. They would be paid at the foreign currency. So whenever we see that on the bond there is a mention about this currency in a currency which is not a domestic currency, which is a foreign currency. So such bonds, we call them as euro bonds, which are not which do not have the domestic currency transactions mentioned, but they deal with a foreign currency. Such bonds are called as euro bonds. Then most important in euro markets, that is the foreign markets and foreign bonds market. Okay, so they are connecting the domestic investors with the foreign companies, foreign investors with the domestic companies. And then what are financial institutions? What are financial institutions? Financial institutions are the ones who um, extend their amount, they invest into various businesses, they extend their amount to people who require funds. So they are financial institutions. Financial institutions can come in many forms, like what is their role? Because they are extending the funds, they are um, they're acting as lenders. So here it is not always that they would be involved in lending money that people can borrow from them. They also play certain other roles also. So financial institutions play the role of intermediation. They can act as a third party, where a third party brings together potential borrowers and potential lenders. So financial institutions, yes, one role is that they lend money to people, those who require money. Yes, they play that role, as well as they also play the role of a intermediary. They bring together the borrowers and the investors. What does it mean? That by guaranteeing that the borrower will repay on behalf of the borrower, they assure the lender that they would pay the amount on due date, or they act as a guarantors. Okay, where a third party, the intermediary, brings together potential borrowers with potential lenders, some kind of a guarantee, some kind of um, vouching that the borrower would pay the amount. So they're connecting two people and also ensuring, or they are acting as a guarantor that the borrower would pay back the amount on the due date. Okay. What are the examples here? It is given some of the examples of intermediaries are the clearing banks, the investment banks, the insurance companies, the finance houses, unit trusts, pension funds, building societies, and others. Now, what is the role of intermediary? So there is something mentioned here. Role of intermediary is risk reduction. Okay. So if there is no involvement of a third party, there is no involvement of a intermediary financial institution, then we see that this doesn't happen. This transaction uh, the transactions which would take place between two entities will not take place. Then because there is an involvement of a third party, the borrower also feels responsible, because there is an involvement of a third party who acts like a trustee, or who acts like someone who will deal with the situation if there is a default arising. So there is some kind of a responsibility felt by the borrower, because there is a third party involved and there are prompt payments. Now it also helps the lender to trust the borrower, because there is an involvement of a third party. Because of that, if in case of a default arising, yes, the third party, who is the financial institution, also will interfere into this matter and ensure that the payments are made promptly. So this is resulting in um, what we call it as a risk reduction. It helps in reducing the risk. Then the next one is first one is risk reduction, second one is aggregation. Aggregation. Okay, so aggregation is because they're connecting the investors. They're connecting the investors um, with the companies, with the borrowers. So what are they doing? Aggregation is total, isn't it? Aggregate is total. So they're pooling up the funds. They are collecting of all the funds from various sources. So the small investors, the uh, those who can invest in small quantities. So pooling up the funds from all of them, and then investing that. Any example which you can quote about aggregation, which are collected in small amounts and then invested into the big investment opportunities?
Mutual funds.
Yes, yes, excellent. Okay, mutual funds. Then we see the insurance schemes. Some of the, not all of them, some of the insurance schemes. They collect small amounts and then they invest into diversified investments. So, okay, that is one way aggregation. Okay, by pooling up small amounts from multiple sources and then collecting the amount so that that can be invested into big investment ventures, or they also think about investing into diversified investment proposals so that some amount of return can be earned, which can be enjoyed by the small investors. So they're acting like an intermediaries. Okay, then we see the next one is maturity transformation. Okay, maturity transformation. Okay, uh, small amounts are collected. Small amounts are the second point when we are discussing about aggregation. These amounts which are collected from multiple small investors, these small amounts are collected, pooled up, and then they are invested. Generally they are invested into multiple things, diversified investments or long term investments, but not all of them would be willing to wait for a longer period of time. So when they are not willing to wait for a longer period of time, uh, for them to get back their return or investment, so in that case, when they seek to have a earlier maturity for their investment, in that case, depending on their requirement as to when they would want their investment back. Okay, see, these small funds which they are willing to invest, they may not be willing to wait for a longer period of time. They want their funds back earlier. So in that case also, they kind of maintain a, a separate pool of funds, or what we call it as floating pool of deposit, or there is a method in which the funds or deposits are in floating sense, that is, it is an ongoing process. So amounts are collected from other investors on an ongoing basis, so they always see that they have the funds available. So those that require their amounts back earlier, their requirement is also met. Their maturity period, what according to their expectation, whatever is the maturity period, that also can be met. So that is maturity transformation. So a financial institution acts as an intermediation, that acts as a third party. The examples are given about who could be an intermediary. So there are few examples which we have mentioned. Then we have seen the what is the role of an intermediary. Role of an intermediary helps in risk reduction because it acts as a third party between the investor and the company. Then it becomes possible to trust the borrower. The borrower also would be prompt enough to make the payments to the lender because of the involvement of a third party. Then we see the aggregation part of it, wherein multiple sources from which the amounts are collected by the intermediary and used in investing them into multiple sources or diversified investment, so that the return can be earned, which can be distributed to all the investors. In case if some of the investors are seeking for a maturity and at an earlier stage but not willing to wait until a longer period of time, then in that case their requirement is also catered to or met, because they look into this method of collecting deposits on a continuous ongoing basis, so that whatever is collected from others can be used for maturing these amounts, because the investment, once it is made into long term resources, it is difficult that they can get back their investment very easily without meeting any loss. So in that case, um, by collecting funds from other sources, those sources can be utilized to make the payment to those that seek an early maturity for their funds. Okay, we come to the next topic called as financial securities. Today's class and tomorrow's class also the theoretical part will be done. So once the theoretical, because there are no numericals till now what we have done, so I will not be taking you through the MCQs. Uh, we will straight away go to the essay section, because I also have to help you out in answering the essay section. So given the time frame, we learn the content, and also as and where it was needed for me to work out these small numerical problems. Per topic, I have taken at least one question. So we can straight away start with the essay section. So maybe tomorrow also, at least a part of tomorrow's class, we will be discussing about what these things are. And after that, the cases which are there in the examination kit the rest of the time. So until February 1, we have classes. Today is 27. So today's class is gone. 28th also half the time we will be discussing about the theoretical aspects. So 29, how many days more, how many classes more we have, whatever are the, whatever is the available time which we have, 29, and we have one more class on first. So those days we will only discuss about cases. Okay. Um, the next one is, what are the financial securities? The So we have here the money market instruments. The money market instruments. What did we decide as what are money markets? A time frame is there. In case of money markets, we see that the time frame is less than 1 year. So any instruments which are traded for a period less than 1 year, we call them as money market instruments. Okay. Then Then we see that the first one is coupon bearing securities. I don't know whether you are aware of these things or not. Um, are you aware of these? Did you learn them? Was the syllabus done in the class, or you still have to do that? So if you give me an idea about that, then I can go accordingly.
No,
FM,
we haven't
not
done.
not yet done. Okay, your syllabus is not yet done, no, in college. That is what I understand. Was the syllabus done or not?
No, ma'am, not completely done.
Not completely done. Okay, done. So you're not aware of this topic. So let's see that. Money market instruments, the first category what we look into is coupon bearing securities. The meaning of coupon is used to denote interest. Coupon means interest basically. So those securities which have an interest rate mention, or there is a mention about what is the amount of interest or interest percentage that is mentioned along with the instrument, we call that as coupon bearing instruments, coupon bearing securities. Okay. Under that, we see that there is a list. List is, first one is CDs. CD means remember these things. CD means certificates of deposit. Okay, certificates of deposit. Okay, so this is also a short-term money market, no? Short-term instrument. So what are certificate of deposit? So whenever see, most of the time, because the time period is less than 1 year, while discussing the various types of assets and liabilities, we have understood that. So, if the investment is made into current asset is a period of 1 year or operating cycle, whichever is longer. So, we there also we were referring to a time period of 1 year. So if the investment is made into current assets, the returns are less. The returns are more in case of fixed assets, but the benefit in case of current assets is the liquidity aspect can be met. In case of fixed assets, the profitability, the return is good, but the liquidity issue is not dealt in case of fixed assets. It's difficult to convert them into cash. So if some investor is looking at investing into a short-term investment, their focus there is basically to convert them into cash as and when there is a requirement. So when funds are available with an investor, a business, then if they lock these investments into long-term resources, so if they invest it for a longer period of time, in that case, when there is a need arising, at that time they will not be able to meet their requirement, what to meet their need or whatever is the requirement of their funds, that will not be possible for them to meet that. So they focus on investing into short-term investments. So one among them is certificate of deposit. Okay, so here we see that a deposit is made. So as against the deposit, there is a certificate. So certificate of deposit. So whenever they want to convert it into cash, it enables them to convert it back into cash. There is no rigidity that it is blocked into that particular investment opportunity. That is not there. But it ensures them that they can have back their deposit amounts. So they can get it back in the form of cash so that their liquidity requirements can be met. So that is the important point there. Okay, so as long as they deposit their amount, uh, we see that these certificate of deposits are available with banks. So when the amounts are deposited with the banks by the investors, then as long as they deposit that, during that period they are entitled to receive a interest, a fixed percentage of interest at the time of depositing the money, whatever is the mentioned interest rate. At that fixed rate, the investor is entitled to receive the interest amount. But once the investor wants the amount back, the investor is also provided with that facility of taking back the deposit amount from the bank. Certificates of deposit. You must have heard about these concepts of fixed deposits. So that ensures the investor that yes, they can have back their investment amount, but for the period where they are investing, as long as the investment amount is with the bank, the investor is entitled to receive an investment. Okay, that is called as a certificate of deposit. Certificates of deposit. Then we have repos. Repos is um, repurchase options. So repos are again purchasing, repurchasing. Okay, so when financial security is um, a financial security is sold. Let's say that. Okay. Um, so there is a business entity or someone selling their securities. Okay, they sell their securities and collect the amount with an assurance that at the end of a specific period, they would again repurchase from the buyer. Okay, so if there is a company, ABC company is if there is a someone selling their securities, so for x amount they are selling their securities. Let's say that $1,000 for which the securities are sold at and then there is also mentioned that this entity will also purchase it back after a while, but with an added amount. Okay, if it is 1,000, maybe another $100 will be added, and it will be bought back at a value which is higher than the initial amount at which the securities are sold. So repurchase. Repo is repurchase option. So repo transaction ensures that the one who is selling them will again buy back after a while, but this time when they are buying it, they buy it at a higher price, which would be the difference between the selling price and the buying price is can be considered as an interest amount. Okay, those are repos, repurchase agreements. Okay. The next category, you're able to follow too much of theory from a long time I've been explaining. You're able to follow? How many are there in the class? And Simran is there, and
Yes, ma'am.
Jeet Singh is also there. Okay. Simran Jeet. Is this your first class, Simranjit? I don't remember seeing this name. Actually, it's not there. Maybe
Ma'am, I think he was there in 2, 3 classes.
that is not a very regular name which I have seen in the participants
ma'am.
list. So that's right. Okay. I think internet connectivity issues also there, I guess. Ashley is
Yes,
joining and
ma'am.
leaving, joining and leaving. So there must be some issue with
Yes,
internet.
ma'am.
Okay. I hope you have followed until now whatever is being done.
Yes, ma'am.
Okay. The next one is discount security. So under discount securities, the first one we see the treasury bills. Okay. When we talk about discount securities, so at the time of issue of these securities, they are issued at a discounted value. So if $100 is the value at so while issuing itself, they would issue it at a lower value. But when they are paid back, the full amount would be face value of it would be paid back. So the difference is the amount which is collected at the beginning only. So let's say if it is 100 which has to be issued, if it would be issued at 98, but while collecting it back, it would be 100 would be collected back. So the difference of two can be taken as interest. So that interest is already collected at the time of issue itself. That is the meaning of it. Is discount instruments. Okay. Uh, so whenever these instruments are issued, so these instruments or the securities are issued at a discounted value, but at the time of paying them, at the time of maturity, at the time of repaying that or redemption time, they pay back the full amount, the face value of that amount. So that's why we call them as discount instruments. Okay. Because it's a short term period, it's a money market instrument, the liquidity part of it also can be met. uh, that is it is for a short period of time, so within short period of time they can get back their amount. So there are various denominations in which or the time periods are different things for which they are issued. Okay, So among the list of it, first we see that the discount securities, the first one what we see is called as the treasury bills. Okay, treasury bills. Generally, we see that treasury bills. Now, these are um, you remember we've learned about CAPM topic, isn't it? Where we were talking about risk-free interest. You remember the formula for CAPM, cost of equity? It is RF plus beta into RM minus RF. That is a formula. So we were talking about risk-free, uh, that is investments or risk-free securities. So treasury bills are usually referred to as risk-free investments. So risk-free investments which are issued by the government, but the government directly doesn't do on behalf of the government, RBI or the central bank. So central bank issues, that is on behalf of the government. So the involvement of government is there. So issued mainly by we see that they are for the requirement of government. Okay, they are issued through the central bank. Okay, it is RBI on behalf of the government issues these bills. So what does it mean issue the bills? So when they are issued, so the general investors they purchase these things. So catering to the requirement. So when they are issued at a they're issued at a discounted rate, and the maturity period, the full amount is paid back, right? Um, there are again various types of treasury period. So when there are certain number of days which are specified on the treasury bill. So we see that some of them have 14 days, some of them have 91 days. So there is a time period in number of days which is specified, and it holds for that particular period. So depending on that, the discount rate is also mentioned. So while issuing, so the investors can uh, purchase them at a discounted value, but when they get back their amount, they get back their full amount. So that is they are called as discount securities. And first one is treasury bills. Okay, because of the involvement of government, we see that such investments are risk free. That's why this rate, the rate which is mentioned on the treasury bills, is generally taken to be as a risk free rate. Right. The next one in the list we see it as commercial bills. Okay, these are also short-term investments. They are issued. They are also issued at discount. But first is treasury bills are issued by the government on behalf of the government. The central bank issues. But in case of commercial bills, we see these commercial bills are issued uh, by large business entities. Okay, so it's not the government or the central bank, but yes, those that can issue these things, these bills, that is large business houses. So there are certain criteria which have to be met by the large business houses. Then only they can go in for issuing these commercial bills. Okay, so if it is not government, it is not the central bank, and if it is issued by the large business houses, we see that we call them as commercial bills. Okay, then the next one in the list is commercial paper. Commercial paper. So commercial papers are also issued by business concerns. So the business houses or the corporations which issue these things. So these are commercial papers. So when when these things are issued, the commercial papers when they are issued, um, see, there are again time periods which are mentioned. The time periods are mentioned for how long would these issue would be there, and at the end of the period, their amount would be paid back to them. The amount would be paid back to them at the full value. Okay, but then the way we are talking about treasury bills as risk free, or we are looking at commercial bills as large concerns which come out, and they have to meet certain criteria so that they can give that, so that their credit worthiness is looked into that, and then mm, only some business houses have that eligibility to go in for issue of commercial bills, but commercial paper, that is not there. Therefore the investors have to look at the credit worthiness, the credit rating of these individual business concerns, then only they should go in for investing in that. So here we see that when uh, the credit worthiness, the credit rating has to be looked into by the investors before they invest. So here it is kind of not a secured form of investment. So when it is not a secured form of investments, we see that investors do not come forward to invest in such a thing. So what can attract them? The attraction to attract the investors to invest into such type of investments is by offering some uh, at a high cost, or the discount rate is quite attractive to the investors. So if they pay less, they can get back more, if that is the concept. So that would be resulting in high cost for the companies. Okay, so only by way of that, wherever risk is more, return is also more. So if the investors are looking at this particular investment as a risky investment, they are also expecting a higher amount of return from the company. So risk is more, return also would be more. So that we call it as uh, commercial papers. The next one in the list we have it as bankers acceptances. uh, bankers had sorry, but bankers acceptance here is um, it is not see there is a um, assurance given on behalf of one party. If there is an assurance given, then uh, I mean, banker vouchers that the buyer would pay promptly on the due date. So there is a acceptance given by the bank to act as an intermediary. So that is called as banker's acceptance. In case if um, the payment is not prompt by the buyer, so in that case bank is accepting that they would take up the responsibility. So first it is assuring that there is, let's say that there are two entities A and B, they, dealing with goods and services between these two things. So if I mean here if there is a third party, so that third party is a bank, if can act as an intermediary between these two entities A and B, then we have looked into that there is some kind of a assurance, so there is a kind of a guarantor's role bank is playing. So if there is A is selling goods and B is buying goods, so on behalf of B, a bank will vouch to A that um, B will promptly pay that. So there is a kind of a letter of credit or something which is vouched against the I mean the transaction, and assuring the selling company that the buying company or the buying individual, the buying entity will make the payment promptly on the due date. But what if the thing is not catered to, or the buying entity is not making the payment on the due date? In that case, there is a default. So in such a case, if at all if a default arises, bank will take up the liability of meeting this payment on the due date. So that is how the bank is giving an acceptance, bankers acceptance, giving an acceptance to the selling company that the payment will be made promptly by the buying company. In case if the payment is not made, then the bank will take up the responsibility of making the payment to the selling company. Okay, Ashley is there. Okay, the next one the next one is FRAs. We see FRAs. What are FRAs? Any one of you? Do you know what are FRAs? I asked for Ashley, so Ashley has to tell me. Forward rate agreements. So before we talk about what are forward rate agreements, do you know what is the meaning of derivative?
No, ma'am.
The other day you were asking about forwards and futures, so I thought you would know that. That's why I was verifying whether you're there in the class or not.
Actually, ma'am, I am having an internet issues today. So
I understood. I was also discussing in the class in your absence that I think there is some problem because you're joining and leaving, so internet connection issues. No, the other day, Monday, you were asking about
yes,
doubts in forwards and futures. So, others, anyone in the class, do you have an idea about what is the derivative? Okay. derivative. So first we need to understand what is the meaning of derivative. Then only I can talk about, because forwards are one type of derivative. So FRAs is forward rate agreements. Right. There are 4 different types of derivatives: forwards, futures, options, and swaps. Okay. First, we need to understand what is the meaning of a derivative. Derivative is an agreement. Okay. A um, derivative is an asset. Okay. Related to that asset, there is an agreement between two entities. This asset derives its um, value from an underlying asset. We'll take one very simple example and try to understand what is this agreement about an asset which derives its value from an underlying asset is what we will look into that. Okay. For example, let's say, okay, you are from Punjab, okay, a land with abundant agricultural produce. That's what we understand. So I'm assuming that is the same thing. Okay, that is the knowledge what we have about Punjab. Let's say that there is a farmer um, who produces wheat. Fine. Now the problems which are faced by farmers is, see, when they produce their product and they take their produce to the market, um, they may not see that the price what they are expecting prevails there in the market. So they may not be able to sell their produce at the price at what they are expecting, or what should be the reasonable price. Okay. So here there is a risk. See, now they are producing. So the crop is not yet available with them, but then now once the crop is available, the produce is available with them, they being able to sell it at that required, at the expected price, whether it would prevail as on the day is not sure. So therefore they enter into an agreement and enter into a derivative agreement with another entity, another person, or another party, to sell their produce to them at a specified rate at some price. So the price of this produce will be decided, pre-decided. So as on the day when the agricultural produce is ready to be sold, so this entire product will be sold to them, or whatever is the product which they have entered into an agreement, that would be sold to the person with whom there is an agreement. And at what price? The price which they have pre-decided as on the day when they have entered into this agreement, whatever is the price which they have decided, at that price they would be selling it, irrespective of what is the price which is prevailing in the market. If the price may be lesser than this price what they have mentioned, the price which they have mentioned in the derivative, or the price could be higher than what they have mentioned. So if it is a higher price, they would be benefited if they sell it in the outside market. But because they've already entered into an agreement, they have to honor that agreement and sell the product to the concerned person at the specified price. What if it is lower than the price what they have quoted in the instrument? In spite also, they will still be exercising their uh, agreement at a price which they have pre-mentioned, pre-decided. So they are ensuring themselves, or they're kind of securing themselves from a loss of fall in the price. Let's say that they have decided, I do not know what is the price, some roughly let's take 50 rupees. 50 rupees is the price per kg, roughly. I do not know. Okay. um, okay, let's say 20 rupees. Okay, not too ambitious. Okay, let's say that 20 rupees is the price per kg. So if somebody is willing to sell 100 kgs at 20 rupees, so They enter into an agreement as on the date when it has to be, I mean, the product has to be sold. It will be sold at 20 per kg. Then 20 per kg, if it is sold, fine. What if it in the market the prices are prevailing at 15 only? Yet he will have to, he would be selling it at 20. So he is ensuring himself against that difference in the price. So they are secured. What if you see that the price has risen to 25? So if the price has risen to 25, yet in that case also it has to be sold at 20. Okay, so there is a kind of assuring themselves as against the risk which happens. So there are certain other terms also which are involved. That is, there is a premium which is involved in that. So the intricacies of it I will explain it in tomorrow's class. So tomorrow I will explain that in detail about what is it. um, then have a mention about it. What are the types of options? The first type of option is forwards, second is futures, third one is options, fourth one is swaps. So since you would be learning AFM later on, so maybe you will not be tested at an advanced level, but whatever are the questions which are there in the examination kit, we'll go through those questions, okay, in tomorrow's class. So there are four different types of derivatives: forwards, futures, options, and swaps. The characteristics of derivatives, the characteristics of all these four types of derivatives, I will explain that in tomorrow's class. Okay, any doubts?
No, ma'am.
Okay, I understand that I have not sent Monday's class, so I will send the recording for Monday's class and today's class. So um, this is all what we have for tomorrow. So tomorrow, um, how do we hedge these? How do we manage the risk which is present in exchange rates, the foreign currency risk, then the interest rate risk is what we have to look into. So tomorrow's class, the theoretical content will end. Then the rest of the time we will work out on the questions from the examination. Okay.
Okay, ma'am.